So, Nick, it feels like the crypto market meltdown has been a domino effect where one failure begets the next. Where did it all start?
Well, we can trace back this meltdown really to the end of 2021 when the Fed started raising rates. So we saw that inflation was basically running out of control towards the end of 2021. And we see the Fed basically starting to commit to their hiking cycle and an aggressive one. So from the end of 2021 to a few weeks ago, we had an over 200 basis point move across the treasury yield curve, including tens going from 1.5 to 3.5. And when that happens, when tightening comes into any market, you see the most risky investments really start to crumble first. So we saw that crypto prices generally started to come down as the Fed started to commit to their hikes. But really, it all comes down to this collapse of Terra Luna, and that's what really kicked off this whole saga.
So, yeah, let's talk about the implosion of this stablecoin project, Terra USD or UST for short. What happened there? And then what was the knock on effect to that crypto hedge fund, Three Arrows Capital?
Yes, so Terra, this UST algorithmic stablecoin, was basically this US dollar pegged coin that was backed by a basket of other cryptocurrencies, not necessarily all US dollars. And there were a lot of people in the Bitcoin arena that were warning about this algorithmic link and how it wasn't stable. Now, UST slash Luna did purchase over $1 billion worth of Bitcoin to keep in their reserves as this, reserve balance to back the stablecoin. But when prices started to go down, the whole thing unraveled. The peg broke. Luna, the associated cryptocurrency with Terra, went to zero. And when Luna went to zero and UST broke, it really sent this segment of crypto asset management into a tailspin because there was a lot of exposure to Luna. The Luna collapse also triggered a lot of forced selling from a lot of these funds, which brought down the rest of crypto prices, and it just started to snowball.
Okay, so we've got this domino effect. It starts with this UST stablecoin implosion, and then that hits the crypto hedge fund, Three Arrows Capital, and then from there, it seems like every other day, another company is saying that they have exposure to 3AC. They're in the midst of a solvency crisis, and so what happens next? Like, how many more dominoes are left to fall?
So, yes, there is a lot of exposure from the 3AC collapse in that lenders were lending to 3AC, and 3AC not only defaulted on those loans, but now during the liquidation process, we're hearing about the fact that the founders cannot be found. And we're looking at a situation that it wasn't just over leverage, but there were maybe some bad actors in there as well. So we have the collapse of 3AC, we have the collapse of lenders that were exposed to 3AC, but we also have something like Celsius, which the collapse of Celsius or the bankruptcy proceedings that we will see with Celsius, that is not directly tied to the collapse of 3AC. Rather, we had this drawdown in all of crypto. We had this really blow up in DeFi. Decentralized finance was supposed to be this area where people could borrow and lend in a decentralized way. But when, the critics of UST, for example, were saying, where is this yield coming from? And really, we see that there were Ponzi type characteristics at Celsius where they were attracting depositors with higher yields just so they could pay down the yield that they had promised their existing investors. So we see Celsius collapsing really under the pressure of the broad misallocation of capital within DeFi, where people were just trying to get yield, not really knowing where this yield was coming from.
Right. And you're referring to the fact that, your mom and pop investors were getting double digit APY that seemed to be fabricated out of nowhere. It seemed like a lot of these platforms were throwing cash at this. It wasn't real yield. And so you mentioned Celsius falling in tandem with 3AC for different but related reasons. And so my question becomes, is this a crisis specifically within the crypto lending market?
So I don't think that lending itself is the only issue here. I mean, if we look at the trigger to a lot of this collapse, which is this Terra Luna link, that's not a lending issue. That is a project that is trying to seek, you know, this is a project that's really trying to achieve something from, it's trying to convince investors to allocate to something that isn't necessarily a good investment. So when people are allocating to Bitcoin or across cryptocurrencies and they're doing so without leverage, if they take a big loss, it will affect their portfolio. But if they're doing this with leverage, it can wipe out everything and more. So that's, you know, the function of leverage here is, I think, the main culprit. The lenders that lent to the players that were leveraging or trying to leverage returns, they are caught in the crossfire, but they're not actually at the beginning. They're just part of the mix of this collapse.
Well, and that's my question to you. How is it that companies were willing to lend hundreds of millions of dollars with no collateral?
It's a great question. We saw that with Voyager, where they lent over 600 million uncollateralized in the form of USDC and Bitcoin as well. Now, why did they do this? I mean, it comes down to the cycle, Mackenzie. If we think about the cycle, the business cycle, during mid, late stage of any business cycle, you're going to have excessive risk taking that isn't conducting, the people aren't conducting the proper due diligence there. And this is really no different here. We think about the housing crisis, the housing bubble in 2007. We think about the mortgage lenders that were lending money to no income, no job borrowers, and they weren't asking many questions. Of course, a lot of those borrowers defaulted and certain lenders collapsed. So it does happen in late cycle where people just they're not conducting the right due diligence. They're over trusting. They are going off of reputation. They're also going off of FOMO, right? That their
Yeah.
next door lender is lending and they're able to get returns from 3AC, who's, paying the vig along the way. But in the end, the music does stop. And in Bitcoin, in crypto, there is no lender of last resort. I think that becomes glaringly clear during a time like this, in which we have real bankruptcies, real losses, 99% AUM wipeouts, and there is no lender of last resort. And so this is, I know there's this term crypto winter.
I
This
was just
is
about to ask you
actually
about that.
this is the fourth Bitcoin winter, but it's really only the second crypto winter. Now, Bitcoin had a winter in 2011 after its first little bubble. It went to $30 and then came back to two. Then it had another winter from 2013 to 2015 after the Silk Road era and the Mt. Gox collapse. Now, in 2017, we had a broad crypto winter because you had this huge ICO bubble, initial coin offerings. People don't hear that term anymore because the concept disappeared. So I'm this time around, certain concepts like DeFi, the term DeFi might not be around in a few years. It might, but it also might not. NFTs, this is something that's have become extremely popular. I believe that there is some underlying technology to NFTs that might gain traction over the coming years, but this idea of NFTs might go away in a few years. We're not really sure. We are in a crypto winter, though, where certain ideas, projects, and monikers, acronyms will go away. They will die. What will survive? Bitcoin will survive. It has gone through four of these winters. It will go through more because it's a new asset class. You see this bubble and bust type of interest that comes into the space. And when everything shakes out, we see Bitcoin remaining and getting stronger over the years as its adoption really is increasing exponentially around the world. We have somewhere between 1 and 200 million Bitcoin users right now around the world using the University of Cambridge data. That number is sure to increase, and I do believe it's going to increase in a way similar to the internet, where we will get a billion and more Bitcoin users over the coming years. And so
Yeah.
I believe that this supports the long thesis for Bitcoin investment,
Yeah.
and Bitcoin will come out of this winter eventually.
So, how long are we in this crypto winter? It's been a rough few months, but are we looking at another multi year protracted period of of depressed prices?
I don't really believe so. So I want to bring it back to Bitcoin's correlation with equities. We've seen an incredibly strong correlation of Bitcoin to the stock market over the last year. And really, when you go back and look at the data all the way back to 2017, the correlation is very strong between Bitcoin and stocks. Now, you do have protracted periods of decoupling, and these happen usually when Bitcoin does its parabolic type of advances where it'll double or triple in the span of a few months. Obviously, stocks are not exhibiting that type of price action during that time. But most of the time, Bitcoin and stocks are ticking together, even though they have varying ranges of movement there in direction. I'm sorry, in terms of magnitude. So what do we see in a cycle? We see that stocks and risk assets generally bottom about half a year, a quarter to a half a year before a recession is over. And that usually corresponds with the Fed starting to signal that their tightening cycle is over. So, what do I believe? I believe that if we are in an economic contraction right now, which Atlanta GDP shows us that we've been in negative GDP growth for half a year, the Fed will eventually stop raising rates, I believe, sometime towards the end of this year. When that happens, the rate of change of monetary tightening starts to decline. Conditions start to become easier. Stocks will bottom and eventually go back up, and Bitcoin will be right there next to the equity market, ready to charge back up into positive territory as the Fed starts to ease monetary policy. And that doesn't mean slashing rates or doing QE again. I don't think the Fed is in play for QE anytime in the next year, as they've really firmly committed to the opposite, quantitative tightening. But they will stop raising rates eventually, I think some point this year, around 3% on Fed funds. And at that point, risk investors will take a look at stocks and Bitcoin and say, okay, it's time to start reallocating to risk assets.